Hello, dividend enthusiasts, and welcome back to the Dividend Uncle, where we delve into strategies to enhance your portfolio's income. Today, we're exploring 3 remarkable dividend yield boosters in my REIT portfolio. Now, what exactly are these dividend yield boosters? These are REITs that offer higher than average dividend yields. They can add a valuable income stream to a diversified portfolio, but it's crucial to understand the associated risks. Daiwa House Logistics Trust Recap. Before we dive into the new reveals, let's revisit one of my previous mentions, Daiwa House Logistics Trust or DHLU. With a robust yield of 9.7%, this is the often mentioned yield booster in my videos. This REIT has proven to be a reliable contributor to my dividend income, due to its resilient business and conservative capital management with 100% of its debt hedged to fixed rates. If you wish to know more about Daiwa House Logistics Trust, I have provided the link to my earlier video at the top right corner. This, however, is not one of the 3 dividend yield boosters I am revealing today. Without further ado, let's jump right in. Our first contender is Cromwell European REIT, trading under the ticker CWCU or CWBU, depending on whether you want to trade in euros or SGD. I would recommend the euro-denominated CWBU as it has much better market liquidity. This pan-European REIT boasts a diverse portfolio, primarily in Western Europe and focused on light industrial, logistics, and office sectors. The REIT has been moving towards more light industrial, logistics properties, which now accounts for more than half of its assets. With over 110 properties across major European cities and more than 800 tenants, it's a diversified investment. It enjoyed a rental reversion of more than 10% based on its latest 3Q 2023 financial results, reflecting the quality of the portfolio. Equally impressive is its capital management. 91% of its debt has been hedged to fixed rates, and there is no debt up for renewal until 2025. The current dividend yield stands at a compelling 13.3%, driven by declining share price due to market concerns such as interest rate impacts and uncertainties stemming from events like the Ukraine conflict. Notably, activist investor Kvarts Capital's recent call for unit buybacks by the REIT due to its attractive price to net asset value ratio of less than 0.6. This signals confidence in the REIT's potential undervaluation and potential. Next up is the REIT giant CapitaLand China Trust, trading as AU8U. Holding an extensive portfolio across China, including shopping malls, business parks, and logistics parks, it's a diverse play in the Chinese market. It had a challenging year so far due to weaknesses in the Chinese economy which hasn't lived up to the expectations even after the removal of COVID restrictions. CapitaLand China Trust's operational strength in the retail segment and ongoing asset enhancement initiatives actually hint at a potential turnaround, with shopper traffic up 35% and tenant sales surpassing the pre-COVID levels in 3Q 2023. But it's wise to brace for some bumps along the way, driven by the weakness of the Chinese yuan or RMB. Due to a 10.5% decline of the RMB against the Singapore dollar, the NPI of CapitaLand China Trust fell by 8.4% for the 9 months year to date. As a result, the year-to-date share price performance of CapitaLand China Trust is down by about 30%. But this has pushed up the dividend yield to a mouth-watering level of 9.2%. Completing our trio is ARUS Hospitality Trust, identified by the ticker XZL. Specializing in hotels in the U.S., this trust has navigated pandemic challenges admirably, maintaining high occupancy rates and revenue per available room. The revenge travel trend within the U.S. has notably boosted its operational performance. The decline in share price could be attributed to higher interest expenses, and fears of a slowing tourism market as the economy slows down. In particular, investors of ARUS Hospitality Trust need to take note of the increase in average interest rates from 3.8% as at end of last year, to 4.7% as at end of 3Q 2023. The interest coverage ratio of 2.6 times also does not inspire confidence. But these are mitigated by proportion of fixed-rate loans, and improving underlying business of its properties. With a strong sponsor in ARA Asset Management, XZL offers an enticing yield of 11.6% currently. In wrapping up, it's essential to remember that different investors have different needs and risk tolerance levels. While these dividend yield boosters present attractive opportunities and can supercharge the dividend yields of your portfolio, they also have certain risks, and thorough research and consideration of your own financial goals are paramount. Always tailor your investments to your unique situation. Thanks for exploring these yield boosters with me today. I will be traveling with my family in the next week and will be slow in posting new videos, so bear with me. Remember, your journey to financial success is uniquely yours, so stay wise and make informed choices. See you on the next leg of the adventure.